We're going to calculate the stock price for Hewlett Packard. And the first thing we need is market cap, which is 12.75 billion. And now the stock price of 9.92. Now we know the shares outstanding. It's just the market cap divided by the stock price is the shares outstanding, 1.3 billion. And what we're going to do today is estimate the future free cash flow of this company, then discount that dollar amount back to today, and then we get a value for the entire company. And we have to divide that value by 1.3 billion to get the stock price. And we're going to see if the stock price is higher or lower than they're currently trading at. Now we need the free cash flow, and we go to the financial section in Google and go to cash flow, and they list free cash flow. 1 year had a negative, which means they spent more cash than they brought in, which is not a good sign, but it's not terrible also if you're using the money properly, like to grow your company. Next is net income, which is on the income statement, and last is revenue, which is also on the income statement. And it looks like they had a really nice jump in, actually a big decline, because they had 50 billion in revenue in 2016, then it declined to 29 billion in 2019. Not a great sign. Let's forge ahead. So we need to look at the capital structure of Hewlett Packard and figure out the discount rate we need to apply to the future cash flows. So the interest they pay on their debt, okay, let me open up the 10K, because as you can see, they don't list interest expense in Yahoo Finance. That's the income before tax. So what we have to do is go to the 10K and search interest expense. Because sometimes Yahoo doesn't list all the details. They summarize some things because they maybe can't fit it on the website, or the naming convention on the 10K doesn't match. So interest expense of 311 million. And now let's see how much debt HP has. So we'll go to the balance sheet, go to liability section, and then the current debt is 4.4 billion. That's debt due within 12 months. And the long-term debt of 9 billion is due after 12 months. So they pay 2.25% interest on the debt, but interest payments are tax deductible. So let's see their effective tax rate so we know what to deduct by. So the income before tax, and the income tax is $500 million. I'm getting this info from the income statement. So they pay 32% in taxes. So the cost of the debt is only 1.5%. And as you see, Hewlett Packard has 52% debt, which is not good. You generally don't want that much debt. Debt isn't bad. It's just when you have too much of it, you have a high interest payment. Not just that, is that if you need more debt, you may run into a point when you just can't afford to get more because you might have leveraged your entire company. So let's move forward. Let's figure out the cost of equity, and we need a beta that's 1.34, the beta in Yahoo. And the cost of equity is 12.61%. The cost of debt is 1.52%. So the reason equity has a higher return than debt is because equity is riskier. In the event of a default, debt holders are paid before equity holders. And in this case, Hewlett Packard, with so much debt, it could go into default, and the equity holders would get nothing. When you invest in a company, as a stockholder, you're considered an equity holder. So you're expecting an appreciation of your stock, and that's your return, the higher price on the stock. When you're a debt holder, if you lend money to Hewlett Packard, you're just getting 2 or 3% interest, which is nothing. So anyways, let's get the WACC, the weighted average cost of capital. That's the blend of equity and debt. And that's 6.84%. And that's what we're going to discount the future cash flows by. And I calculated 4 years of free cash flows based off of the information in their financials. And then I calculated a terminal value using the Gordon growth model. And on another video, someone calculated the Gordon growth model and said, it doesn't match what I'm calculating. And he was right. My number doesn't match the Gordon growth model. I start off using the Gordon growth model, and then I reduce it based on the debt a company has. And I also reduce it if they have a low market cap. And I was able to identify how much to reduce because I've now valued over 100 companies, but it's constantly changing. Every day, multiple people ask me, can you send me the model? They think they'll be rich if they have the model, they have all the information. But all the time I'm changing the model because I keep finding new information. And the model is just a prediction of what's happening today. It has nothing to do with the future. There's no model that could have predicted Amazon was going to be $1 trillion company the first 10 years Amazon was out. Nobody can predict the future. They could only predict the present and try to estimate the future. So even though I calculated the free cash flow, we have to discount those numbers back to today, and we used a WACC to do that. And the value of the company, according to the model, is $3.7 billion. And when you divide that by 1.3 billion shares, we get a stock price of $2.90. And I'm really happy that I was able to fine-tune my model, because the previous model would have had a really high stock price, like $100, because that's based on a company with no debt. Now that I built into the debt into the model, I think it's more realistic. So this is the historical stock price of Hewlett Packard, and it's been coming down. As you can see, it was around 20 at its peak, and it's come down to under 10. So with so much debt, I'd be a little concerned. But this is a big company. It's $50 billion a few years ago, and it's still $29 billion in sales. It's a big number. So it's really how you feel about the company. This is just how my model comes out. But everyone, as you know, has their own opinion on the value of a stock. This is just my model and my opinion. So thanks for watching.